Speaking of gold, nasty bear flag starting to form here, guys. Again, this is not a good chart. It broke down. Now it's bear flagging. Again, you can see this trend line. It got right into my level I gave, slammed there. Now reversing back to the downside. We're just waiting for that breakdown to occur. Be interesting to see. Also, one thing I'll just throw out there, what's going on with oil, with Iran, with this global conflict now, is a recipe for gold to outperform, and it's not.
Global debt reaches record all-time highs. Trust in fiat currency is collapsing. Trust in government debt is no longer what it once was. Instead, these institutions are stockpiling gold, physical gold, at the fastest rate in modern history because they know it cannot be devalued. It cannot be inflated away the same way a currency can.
A dramatic shift in global markets is drawing attention to gold and silver as uncertainty builds across geopolitics, inflation, and the global financial system. In a recent market breakdown, Gareth Soloway, chief market strategist, pointed to troubling short-term technical patterns forming in precious metals while still maintaining long-term bullish expectations. At the same time, Kenney of ITM Trading described a deeper structural transformation underway as central banks steadily accumulate physical gold and confidence in fiat currencies weakens. According to Gareth Soloway, the near-term chart structure for gold is flashing caution signals. He notes the development of a classic bear flag formation after gold broke a key support level. This pattern, where prices briefly consolidate after a sharp decline before potentially moving lower again, suggests that gold may not yet be ready for its next upward leg. Soloway emphasizes that geopolitical tensions, particularly involving Iran and escalating conflict across the Middle East, would normally push gold significantly higher. Yet the metal has not responded with the strength traders would typically expect. For experienced market observers, that divergence becomes an important clue about short-term sentiment. Silver appears to be displaying a similar technical weakness. Soloway highlighted a rejection at a critical resistance level followed by another developing bear flag. In his analysis, this structure could lead silver to revisit support near the $70 to $71 range. If broader market stress continues, he believes the metal could potentially drop further toward $50 to $54 per ounce before stabilizing. His view is not that the long-term bull market is over, but that the metals may experience a cooling period before a stronger move develops. If you're finding this analysis helpful, take a moment to like this video, subscribe to the channel, and hit the bell icon so you never miss timely updates.
Speaking of gold, nasty bear flag starting to form here, guys. Again, this is not a good chart. It broke down. Now it's bear flagging. Again, you can see this trend line. It got right into my level I gave, slammed there. Now reversing back to the downside. We're just waiting for that breakdown to occur. Be interesting to see. Also, one thing I'll just throw out there, what's going on with oil, with Iran, with this global conflict now, is a recipe for gold to outperform, and it's not. And those are the breadcrumbs that a good trader is always keeping an eye on. What does that tell us? Why isn't gold pushing up here? Those are things that do concern me. Now, listen, I'm a huge long-term bull on gold, but the chart near term and the factors that I just mentioned, those tell me gold is going lower in the near term. Same thing with silver. Let's look at silver real quick. Look at this, got rejected right off of this level. Look at the bear flag it's starting to put in here. And again, this is a recipe for a retest of 70 to 71. I still think silver eventually goes down to $50 to $54 per ounce. So really remarkable here. Let's do a quick check-in on the ES futures again. Futures again are moving lower. So you can see we're starting to see a little selling pressure after a small bounce. So futures, again, they are off of their lows, but again, we are sharply lower here. Then if we look at oil pushing back to 106 here. We had just gotten down to 105. You can see it's already bouncing on the chart here off this low. Again, huge move up. We, again, really saw escalation over the weekend, right? I mean, and to be fair, to me, I don't see any real easy off-ramp. I mean, either the president has to back down, call it a deal, whatever he wants to call it, or you got to send boots on the ground, which is not going to be a popular aspect either. But Iran has a lot of military capabilities. They're still striking their partners, and it's not something that's easily, it's not like a Venezuela situation, right, where you just go in and extract the leader. Their leadership is much more entrenched, has many levels to it. And we know this from past wars in the Middle East, right? The U.S. has gone in many places, Iraq, Afghanistan, etc. It's never a one and done type of thing. And there might have been a miscalculation here, especially as close to the midterms as we are in the US. So let's take a look first at the S&P futures here. What we're seeing is the S&P futures down 1.58%. Notice that on Friday, we broke major support. So almost like a signal that the market had broken support on Friday, signaling further downside that we're seeing now. Now, how low could the S&P 500 go? Well, basically, we're looking at this technical support. Now, I'm going to flip over to the S&P so we actually look at the S&P. Now, the S&P futures are great, but again, for actual numbers we want to pay attention to tomorrow, let's take a look. But you can see if we flip over to the S&P, it is the same chart here. And you can see, again, we put in the trend line right here. That's the one we broke. Now, what's more important here, if we flip over here, guys, I want to keep you guys posted. This parallel has guided me, and you guys know I've been continually since the start of the year talking about this parallel and how it likely meant the markets had topped out. We hit it right over here in October of last year. We then have a beautiful rounded top, which is technical distribution or unloading by institutions into retail. Now we've broken lower. So let's put that trend line in again right through here. Let's draw it through. And there it is. Friday, we broke below. We closed below. Right now, we're trading sharply lower. Now, the next level I'll be watching on the S&P futures is right here, 65.50 to 65.30, right there. Pivot low and pivot low right here. Again, this is a pivot low going back to October of 2025, big down day. Look at the size of that down day right there. And then this huge reversal candle in November put in this low. And again, notice how this side was right before the high pivot that touched this trend line, this parallel channel, which was major resistance. That actually, even though we went slightly higher on the S&P, this to me was really the topping signal. In fact, the NASDAQ never went higher than the October 2025 high. But again, here we have it right here, the low pivot right there. We touch the line, then we come down, we touch the line, then we do our rounded top. I think that's where we're headed in the next few days. Now, again, doesn't mean we're going to get there tomorrow. Maybe the markets can rally. Essentially, what we are driven by at this point, folks, is simply news driven based on what is going on in Iran, the military action from the US, the war, how many oil depots are being struck, what's going on there. And ultimately, if there's a positive headline, a de-escalation, markets could rally up sharply, although I still think the nail is in the coffin at this point. So sure, we can get a rally, we can get a reversal. We'll have to watch the futures in the overnight if any big headlines that are positive come out. But as of now, even if we do rally, you're likely going to see the markets have an up day or two and then go right back down because economically we're in a lot of trouble. Think about it. The non-farm payrolls was horrible, which is, again, the jobs market. That just came out on Friday. Then you look at other factors. For instance, what we're looking at with inflation, just two Fridays ago, the PPI data, producer price index, inflation data, that was horribly, sharply higher. Then we had PCE data, which was hotter. So inflation is going this way even before you factor in $110 a barrel oil, or even $100 oil, or even $90 a barrel oil. I mean, basically, when those numbers came out, they were from February when oil was still at like $65 to $70 a barrel. So we know inflation is going to be ramping up here even after it was already hot. Now you have a weakening labor market that includes now potentially the nastiness of stagflation. So it's not a good situation. Even if oil does come back, let's say to $80 a barrel, it's still going to have an inflation impact and the economy is still slowing.
Beyond precious metals, Soloway also examined weakness in equity markets. Futures tied to the S&P 500 had already broken a key technical trend line that had guided the market for months. He described the recent market structure as a rounded top, a pattern often interpreted as institutional distribution where larger investors quietly reduce exposure while retail traders continue buying. If that interpretation proves correct, the index could move toward the next support zone between 65.50 and 65.30. Escalating tensions involving Iran and potential disruptions near the Strait of Hormuz have pushed crude oil prices sharply higher, intensifying inflation fears. Higher energy costs typically ripple through the global economy, increasing transportation expenses, manufacturing costs, and consumer prices. At the same time, recent U.S. economic reports have suggested a weakening labor market and persistently elevated inflation readings, raising the possibility of stagflation, a rare and difficult environment where economic growth slows while prices continue rising. Taylor presents a broader structural argument for gold. She notes that central banks around the world are purchasing physical gold at the fastest pace seen in modern history. These institutions, which traditionally held large amounts of government bonds and reserve currencies, appear to be gradually shifting their strategy toward tangible assets that cannot be created through monetary policy. Let's get back to the video.
The central banks who are responsible for creating more units of currency, they no longer want fiat currency. They no longer want government debt. This isn't even just a U.S. problem. This is happening all over the world as global debt reaches record all-time highs. Trust in fiat currency is collapsing. Trust in government debt is no longer what it once was. Instead, these institutions are stockpiling gold. Physical gold at the fastest rate in modern history because they know it cannot be devalued. It cannot be inflated away the same way a currency can. But this is where it gets scary for us because as the Fed is forced to step in as the last buyer, right? The buyer of last resort, as these investors continue to move away from U.S. Treasuries because it's no longer a safe haven asset, inflation is going to rip higher. Meaning that our purchasing power, our savings, our retirement, any dollar-denominated asset is going to be reduced in value. And there's really nothing we can do about that. All we can do is make sure we're protected outside of the dollar, outside of U.S. debt, outside of their devaluation scheme, right? For me personally, that is with physical gold and silver. It has withstood the test of time for thousands of years because it is real money. It has intrinsic value, and they cannot print more of it with the push of a button. It's why central banks are buying the most gold in modern history. They're stockpiling it, moving away from government fiat promises and into real tangible wealth. And I always say, don't listen to what they tell you, right? Watch what they do. And it is clear from their actions how we should be protecting ourselves as well. Instead of falling, U.S. bond yields are actually rising, which means that not only are investors not rushing into U.S. debt, but they're actually exiting, selling off their U.S. bonds, which raises a much bigger question. Is this a one-off having to do with today's events specifically, or is this part of a larger structural change where U.S. government debt is no longer seen as risk-free? And once we answer that, what does it tell us about what's coming next? Well, if we look at central banks over the last few years, they have been steadily reducing their holdings of U.S. treasuries, particularly China and the BRICS alliance, especially following Russia's invasion of Ukraine in 2022, when the United States froze and seized Russia's dollar reserves, sending a warning message to the rest of the world that by holding U.S. debt, your assets are never really yours. They are inherently always at jeopardy and at risk of being frozen, seized, shut off with the push of a button. And once that trust is broken, it does not come back. But now, layered on top of all of that, today we have oil. Now, globally, Iran itself accounts for less than 5% of total oil production. But of that, 90% goes to their number one oil partner, China. So China is not going to be pleased by this escalation of events, which has led many to believe or speculate that China could retaliate against the United States by further selling off their U.S. treasuries. Not only that, but Iran also has tremendous leverage over a small but mighty Strait of Hormuz, a strait that controls 20% of global oil production. A further escalation in the scale and scope of this war in the Middle East could directly impact oil and gas prices here in the United States, having many concerned around fears of inflation, especially given the timing of what's going on here at home with U.S. debt, particularly the massive refinancing wall that the United States is running into this year. Now, some of that debt has been refinanced already, but we're talking about a almost $10 trillion wall in 2026, where debt has to be rolled over at today's higher rates. But this is where all of this starts to impact you. When we're talking about trillions of dollars that needs to be refinanced at higher rates, you can imagine that it is in the US's best interest to keep rates low, especially during this refinancing window. We're sitting at this point in time where oil prices are likely going to go up. Inflation is going to be going up. We have a liquidity crisis over here in the banking sector and private credit that is going to force the Fed to step in and print more. As all of these forces come together at the exact same time, the government is stuck in a bit of a catch-22. Do you try and slow the rate of inflation with higher rates, but then you risk this refinancing mountain of debt, or do you let inflation rip higher because essentially it devalues the real value of the debt? That is historically what we have chosen every single time, and I don't believe that this time will be any different. But yields rising on U.S. debt is essentially a vote of no confidence in the United States from investors. So if we have investors moving away from U.S. debt, which means that we have to increase the yields or offer more interest to attract buyers at a time when we're trying to keep yields low, when we need buyers more than ever, this is a serious issue, especially because historically, these times of uncertainty have been bullish for U.S. debt. People have poured into U.S. debt, but now we are seeing the pattern break because U.S. Treasuries, U.S. bonds are no longer viewed as a safe haven asset the way they once were.
Kenney also highlights growing concerns about the long-term sustainability of global debt levels, particularly in the United States. As trillions of dollars of government debt approach refinancing, rising interest rates could dramatically increase borrowing costs. If investors demand higher yields to hold government bonds, policymakers may face difficult decisions between controlling inflation and maintaining financial stability. The divergence between short-term technical weakness and long-term structural demand creates a fascinating paradox for precious metals. On one side, charts may signal temporary corrections driven by liquidity pressures and investor positioning. On the other, central bank accumulation and global debt concerns suggest that gold's role as a monetary anchor could strengthen over time. Markets often move through such contradictions, where immediate price action does not always reflect the deeper forces reshaping the financial landscape. If geopolitical tensions intensify and global investors continue shifting away from traditional safe haven assets, the question may not simply be whether gold and silver will rise, but when the broader market fully recognizes the scale of the transition already underway. Could the current short-term weakness in gold and silver actually be the quiet setup for a much larger move once global liquidity pressures ease and structural demand becomes impossible for markets to ignore? If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.